The focus of the Fed is shifting. It's no longer about whether the labor market is cooling too rapidly. The concern right now is elevated inflation. And with markets pricing close to 2 full rate hikes by the middle of next year, every inflation indicator carries a little extra weight. One such measure sits inside the ISM Services PMI. It's called the Prices Paid Index. Now, rather than measuring inflation directly, it asks services firms whether the prices they are paying for inputs are rising, falling, or remaining unchanged. Those responses are then combined into what's called a diffusion index, providing a snapshot of inflationary pressures across this sector. Like any indicator, it's not perfect, but history suggests it's been a pretty useful inflation reference guide. Looking first at CPI, you can see that as the index has moved higher over the past 2 decades, consumer inflation has generally moved higher as well. The relationship with producer prices is even stronger, reinforcing the idea that the index provides a useful read on upstream inflationary pressures. But where the rubber really hits the road is what the index has historically meant for the inflation rate. That's where this reference guide comes in. Readings in the low 50s have been associated with CPI around 1%. Move into the 60s and inflation has typically averaged somewhere between the mid-2s to the low 3s. Once readings push into the 70s, as they have recently, both CPI and PPI have historically been much higher. Now, that doesn't mean the next inflation report will print these exact numbers. Think of this as a benchmark rather than a forecasting tool. So if inflation remains the Fed's primary concern, don't just focus on the headline ISM Services PMI print. Spend a few seconds looking at the prices paid measure as well. Best of luck with your trading. I'll catch you next time.